This is Gary Atencio with CNTV, and today we're in Michigan. I'm here introducing model-based investing, where you can unlock unprecedented investment returns with a revolutionary approach and outperform the market 8 times with minimal effort. I'm joined here with the author of Earn Twice, the S&P. Lee, thanks so much for joining us here today.
Thank you.
I'm going to start off a little bit about yourself. You were formerly educated at the Georgia Institute of Technology. You became a chemical engineer with over 40 years of experience in model building and trading. Your journey really began with energy projects where you had no prior experience and worked on projects that really kind of forced you to think differently, building models from the ground up. In the beginning, you said that the stress of trading nearly killed you. So take us back to that story a little bit and share with us how you became determined to build a model that could deliver consistent high performance results.
Well, what happened was I had a large trade on and it was going against me. And in that process, the stress caused me to get a very deadly form of cancer. I had a small group. And so after I got over the treatment and what have you, I told them, I said, we got to lower the stress in the group. So what we've got to do is develop models that are based on fixed rules. So we looked around, we talked to all of our friends, and really nobody had ever had anything that was significant. They would have rules, but they wouldn't last for long periods of time. So I mean, we read a bunch of books and we tried everything. And to be honest, that went on for years. Even once I left that company and went on, I was still messing around with rules based investing. So what happened next was it was after I retired actually, or about the time I retired, I realized I was talking to a guy that had a very good investment, and I asked him what it was, and he said it was basically the S&P plus another 20% that was volatile. So I said, well, that's a good idea. I didn't like what he was using, which was international funds. So I was sort of stuck. So another 10 years lapsed, and I found out about T triple Q, and that was perfect for me. The only problem was it was a little more volatile than most people would want. So I had to find a way to at least sort of minimize somewhat the volatility of it. And it took me another 10 years before I found that. And that was last summer.
Wow.
At that point, then I started developing the model.
Yeah, that's fantastic. What a story. Like you said, you struggled at the beginning with that. Let's start off, first of all, for those in our audience who may not know what a stock market index is, like the S&P 500, can you explain, first of all, what is Standard& and Poor's 500? What is that?
Well, it's the 500. I don't know if they're all the largest, but it's basically the 500 largest stocks. And the index is what they call cap weighted. In other words, the size of the company determines what percentage of the index it occupies. So like right now, you've got about seven, the fabulous seven, they make up almost 37% of the S&P index. So although it has 500 stocks, they're not equally weighted.
Interesting. So really, this is a measuring stick that includes around 500 of the largest U.S. companies, and it reveals how well they're performing. Why has that been your choice index to use, would you say?
For 40 years, I contend that we've been in model-based investing, and what it was Bowl with Vanguard said, the average person can't beat the stock market, so just buy the whole market. So gradually, that became sort of the standard for a lot of people as they would buy the S&P. So that's sort of the benchmark, and about 85% of the people cannot beat it to this day, and this has been going on for 40 years. So it strikes me as a very good fund. So that's the base position in the model, and then there's the second position, which is T triple Q.
Are there other indexes out there that exist to track different segments of the market? And can you give us some of the examples? And how does your model measure up against those as well?
They're all yeah, there's I wanna say ETFs, which a lot of those are index based, or there's maybe 3,400, something like that, I would say. The reason I picked the T triple Q. Two reasons. One, it's the best performing triple over the past 10 years. And the second one is that the construction of it represents the 50 fastest growing stocks or price appreciating stocks. It's not exactly the Nasdaq index, but a lot of them were Nasdaq stocks, which are technology type stocks. But it's the ones that are growing the fastest. And the nice thing about this index is it allows the stock to increase in weighting if it's going up. And if it's not going up, it reduces its weighting. So it's constantly picking the absolute best 50 stocks to be in your ETF, exchange traded fund.
Interesting. I mean, in your book, readers will discover a novel method that really revolutionizes the landscape of financial investing. So let's start off with what is model based investing?
Well, first of all, it has to have fixed rules. The second thing is you need a track record to demonstrate that it works. And then for me, the third piece is it has to outperform ratable, which in this case would be the Standard and Poor's 500. It's got to be able to make more money than that. So as a general rule that what you're looking for here is in the best of all worlds, you, the investor, don't do much. The model itself takes care of everything. There's a few rules you have to follow, but that's it. There are only 4 rules. But the two ETFs, that would be the Standard and Poor's 500 and T triple Q, they pick the stocks for you. And the model doesn't need to really know market direction because um, i- it's not really totally directionally. Um, its value doesn't come totally from market direction. It comes about half from market direction. About half of it comes from market volatility. So the TQQ is bouncing up and down like I'll think of it as an oscillating line, whereas the S&P is more of a straight line. So that oscillating line, when it's high, you're lowering that position. You're selling off portions of TQQ, and when it reaches the bottom, you're buying more shares. So it just does that over and over and over, and that makes this model very repeatable. Unlike most models, they see something, and then 10 years later, they may see the same thing. So it makes it very difficult to know what the future performance will be.
So definitely not direction based. I mean, this book uncovers a new approach that forecasts a return 8 times greater than the S&P 500. I mean, what's impressive to me is that this claim is actually backed by a performance of over a quarter of a century. I mean, can you explain to me a little bit what's happened as you've seen this work time and time again?
In the last 26 years, there are basically 3 different markets. You had 12-year period where the S&P really didn't change in value, but during that 12 years, it had 2 40% corrections, which are the largest corrections we've seen in the past 26 years. Then the next 9 years was pretty much the market just went up and up and up and up and up. And then the last 5 years, you'll have what I call volatile and rising prices. So it's a very volatile market, but the prices were also rising. In each one of those cases, the model outperforms. Now, the outperformance is lower in that first case. It's about 8 percentage points. In the second case, it's about 17 percentage points. And in the third case, I think it's around 27 percentage points. What's happening is that under all these conditions, you're always going to get outperformance. Not every year, but over a 5-year period, you'll see consistent outperformance.
Very consistent. I mean, this unique model, crafted and refined over several decades, delivers higher performance. And you say it's governed by fixed set of simple rules. Can you kind of give us an example of what rules are built into this?
I have some friends that asked me one time, "Well, why are you the person that figured this out?" And I said, "Well, let me ask you a question. How many people would build a model that only looked at prices once a year?" And they said, "Well, no one." I said, "Well, that's the reason I'm the one that figured this out." So obviously, rule one is you rebalance once a year at the end of the year. The other three basically dictate how big the T triple Q position is when you rebalance.
Obviously, this is not just theory, but will these practical, actionable strategies really serve as a guide, maybe even as a roadmap in the process of investing, even for those with minimal experience in the financial market? I mean, for myself, I know nothing about stocks, but yet this has me pretty curious.
When I talk to people, a lot of people say, "Well, Lee, I like what you're saying, but I don't want to put all of my funds into this one strategy." And I said, "Well, you can think of it this way: is that this is a base strategy. You're starting off with basically 32% returns per year for the last um, 14 years." And from that, you can add your own strategy because the model only really takes up about 50% of the portfolio. So you can still do your own thing in the other portion. And I bet at that point you'll realize how hard it is to beat the S&P.
So it's controlling 50% of that. It still gives you some leniency to do what you want to do in that way. In your book, you challenge conventional wisdom, stating it's possible to secure high returns without the need for constant monitoring and adjustments. So we're talking pretty minimal maintenance. Is that normally not the case with traditional methods?
Most people think they're investors, but they're really traders. And by that I mean they only hold a position for about 6 months. But in this model, you're holding positions on average for 8 years. Then you're making slight adjustments every year, about 12% of the portfolio changes, but basically you're holding things for very long periods of time. And the key to wealth is holding positions for long periods of time. So the challenge is to know what to hold for a long period of time. And then when you're holding it for a long period of time, for it to continually to get better, which is what this model does. Those two ETFs are constantly getting better. Um, and I think that's a huge challenge for most people. They struggle. They think they can beat the S&P, but what it was my experience too. I was not a very good trader. And what I'll tell you, the number one reason that people can't beat the S&P is buying things that are going up and selling things that are going down. The typical investor sells things that have gone up and buys things that have fallen. They're doing exactly the opposite of the S&P, which is why it makes it so difficult to beat the S&P.
So much different. Definitely different. We're talking about day traders, not even monthly traders, really. This is for the long haul, really investing. The reason myself and maybe others out there have never delved into stocks is because, well, first of all, I don't like high risk. Yet you do not advocate for risky, high stakes trading, but instead a methodical, rule based approach. Are many people pleasantly surprised at this, and what has been some of the feedback?
One of my big points is that when you talk to financial advisors, they're going to point out the risk. And there is drawdown, but this model makes so much money that the drawdown's really not a risk because after a couple of years, you don't ever have a losing trade. And if you never have a losing trade, in theory, it means you have zero real risk. I contend that most people talk about risks like risk adjusted returns or diversification, but they don't talk about lost opportunity costs. And to me, lost opportunity cost is the greatest risk. So I'm basically 19 points above the S&P with the best version. So that means every year you're not in the model. You have a cost of 19% if you own the S&P. The typical person is 5 percentage points below the S&P. So they're losing 24% a year. And there's no way to ever get that money back. It's a constant drain. So what I contend is that the lost opportunity cost makes this strategy a lot less risky. And it's more, I mean, if you look at people like Berkshire Hathaway and all of the greats, they've always been long-term holders. That's how you get wealth.
You teach that good old fashioned principles of patience, discipline, and consistency can yield extraordinary results. Is this rewarding information to share with others, hopefully saving them the struggle that you once encountered?
So I tried a long time to trade on my own, and then I tried to develop models, and it took a very long time. So this is like 35 years in the making. Now, could somebody else come up with similar ideas? Of course. Um, I've made it my sort of one of my primary purposes in life is to give the investor the best model I can come up with. And so recently I looked at, well, could you improve the model if you bought within the year? Because I only buy once a year. And I looked at it and I went through, there were 19 cases, 19 different years. And I looked at it and the final answer was that really did not improve the model. And I'm continuing to look for ways to improve the model. I'm working on 2 additional models that could be plugged into that 50% that is not part of the TQQ position. And those 2 models have the potential to increase the performance of the portfolio a lot. And that's my constant goal is to build those models.
I'm going to have to send this to my sons who are much younger than I am. They've got a lot of investing to do in the future. I'm pretty excited for that. Thank you so much. Viewers, let's take a look at the bottom of the screen right there. What you're going to see is his website. On the website, you can find more information. He's even got graphs there about his book. This teaches real strategies, not just theory, that have been tried and tested in real world scenarios, standing the test of time and really throughout market changes. You can find the book Earn Twice the S&P right there on Amazon 24/7. Once again, that is Lee Ekholm helping investors earn 8 times the S&P with minimal effort. This is Gary Atencio with CNTV, and if you don't know, now you know.